welcome to BQ Prime. A very good afternoon to all the viewers. One company that is in focus in today's session is a Canfin Homes, and this is on the first quarter numbers that have been reported. Clearly, if you go to see the net interest margins, has been a positive for the company as well as the NII, and the lower provisions is something that is working really well. Joining us on the show to discuss more on the future roadmap is Mr. Suresh S Iyer, MD and CEO at Canfin Homes. Good afternoon, Suresh, and welcome to the show. Firstly, let me congratulate you for the first quarter numbers.
Yeah, good afternoon. Good afternoon. Thank you. Thank you for inviting us.
Always a pleasure. Suresh, my first question coming to you is overall, clearly the earnings have beat what the street was estimating, and that is mainly driven by the expansion that the company has seen on the net interest margins front. The first question is this number sustainable in terms of the coming quarters as well? And if you have to look at FY24 as a whole?
Yes, the numbers I think, are sustainable because in the beginning of the year, we had indicated that there is a part of the portfolio which is yet to experience the rate hike, the repo rate hike which was there, because we are having a lagged effect because of an annual reset option that we offer to the customers. So now majority of the customers now have already experienced it, and there is still a small portfolio which is yet to experience that rate hike. So going forward, we should be able to look at it, and we are working on the borrowing costs also. So we should be able to maintain this NIM numbers.
Right. Apart from that, Suresh, the credit cost is something which was slightly higher in this quarter as compared to what the street was estimating, but that was mainly on the back of the slippages that we've seen from the restructured pool of advances. Where does it stand currently, and what is the target that the company has towards the end of the year?
We have a gross NPA of 0.63, which is a little higher compared to the 0.55 which we had in March. But that's mainly because we had a 18 crore slippage from the restructured book, which we had already indicated at the beginning of the year itself. Because the entire restructured book of about 695 crore has started to come out from the restructuring in February only. So the first quarter was the first time when we actually estimated. We had indicated that probably there could be up to 10% slippage, which is in line with the market on the restructured book. However, the numbers show that in the February, March, whatever has happened and the 3 months have elapsed, only about 18 crores, which is about 8.67% has slipped into NPA. So that's a little better than what we had anticipated, but we will stick to the numbers that we had given at the beginning of the year, that we could end up probably not more than 0.7% in gross NPA.
Right. If you talk about the incremental disbursements as well, right? And that also, if you're talking at a higher interest rate, you already mentioned about it. The repricing that has happened already in the first quarter, that is something which has actually offset the impact of, in terms of cost of funds, right? Now, going ahead as well, what's the quantum of repricing that can be expected, and by how much will it improve the yields according to you?
We still have about 12,500 crores of the loan book, which is yet to experience one rate cycle, because we had done it in 3 tranches last year. So we still have about, if I spread it over the rest of the 9 months, then we have about 3 to 5 bips, which can still go up from here. But that is on the asset side. We can still look at about 3 to 5 bips, which we still have on the entire book.
Okay. And overall, if you see in terms of asset quality as well, as you mentioned, slippages, you're staying with the number that you've given in terms of FY24. What, according to you, will be the key monitorables, for the company in FY24?
We have a growth target of about 18 to 20%, which we have indicated. As of now, we are on target, and one of the key monitorables or one of the key aspects that we are looking at to get this growth is an increase in the ticket size, because we are also looking at APF as a model, tying up with builders for their projects and approving the projects, from where we can get bulk business and direct business as well. So this is one aspect which will be monitorable. We have also indicated about 15 branches that we plan to open during the year. And we are on track. About 4 branches we should be opening in this quarter, that is Q2, and the balance in the next 2 quarters. So that also we are on track. So hopefully these are the few monitorables. Obviously, the restructured book, which we have indicated, will also be a monitorable. We are closely monitoring it, and we are looking at this. we plan to work on the NPA also so that we don't cross that target. Basically, these are the three things. On the NIM side, we are confident we should be able to maintain this.
Right. One thing that you mentioned, Suresh, right now is in terms of, the way the ticket size movement will happen. So currently, what's the average ticket size? And if you're seeing a demand which is higher in, higher ticket size properties, what will that average ticket size actually move to?
See, the Q1, we had a average ticket size on the home loan book of about 22 lakhs. And the APF that we are talking about for tying up with builders and approving the projects, those projects we are targeting out 25 to 1 crore kind of property values. So there the ticket sizes will be slightly higher. So hopefully we should end up somewhere between 25 to 27 lakh as average ticket size by the end of the year.
Right. Another aspect I want to consider with you is with regards to the commission to the DSAs. Now, in terms of the business model, currently 80% of the channel mix comes in with regards to contribution from DSAs, where the company pays almost around 40 to 43 basis points kind of commission, right? You have been moving to a model in terms of where you're looking to do tie-ups, which are direct tie-ups with developers. If that happens, how are you seeing the channel mix change? Where is it currently? Where do by when do you see it actually more in favor of the developers, and by how much will you be able to save in terms of the commissions?
See, the DSA channel is a critical sourcing channel for us. So it is not that we are going to cut back on the DSA channel, but we are trying to push the direct business as well. So going forward, while the DSA channel will continue and we will continue to probably get the same amount of business, but we are looking at the direct business contributing about 20% of the, this DSA, this business coming from the APF product and this APF tie-ups contributing about 20% of the incremental business in about 2 years' time. So this 80% that we are seeing today should come down to around 60%.
Right. And so that's the view that we have so far. Thank you, Suresh, so much for joining us on the show, because this gives us a lot of clarity in terms of what's in store for the company. And in anyways, the first quarter has actually performed really well as well. So lots to watch out for going ahead. Thank you. Stay safe and speak to you soon again. So that's the management of Canfin Homes, clearly indicating in terms of what's the strategy going to be with regards to the coming quarters. They do maintain the FY24 guidance that they have initially given as well in terms of the AUM growth, which is of around 18 to 20%. However, the slippages is something that the company is monitoring closely. And if you talk about, the restructuring of the book, that is something which will help them offset the impact of the cost of capital as well. So that's a key highlight in terms of Canfin Homes. That's all that we have in this session. Lots more lined up on the other side. Please stay tuned to BQ Prime.